Welcome to Total Convexity, a weekly financial podcast that caters to professional finance individuals, high net worth investors, family offices, and other sophisticated financial professionals. Join our hosts, hedge fund manager Jim Wang and Henrik Niehaus, as they explore the interconnected world of global macroeconomics, central banks, and capital markets. Comprehending the intricate web of global macroeconomics, central bank policies, and capital markets isn't just an option, it's a necessity. Whether you're a chief investment officer, financial analyst, entrepreneur, or simply someone curious about how the global economy and capital markets function, this podcast serves as your compass through the intricacies of the global financial landscape. In each episode, we will delve deep into the influential factors shaping our world, from global economic trends and central bank policies to capital markets and trading strategies. We will demystify financial jargon, clarify complex numerical data, and provide you with insights from experts in the field.
Total Convexity Episode 2 is recorded on October the 6th, 2023. I'm your host, Jim Wang. Joining me is my co-host, Henrik Niehaus.
Hello, everyone. I'm glad to return to the second episode of our podcast series. In our first episode, we discussed our investment framework and processes which focus on the three-way reaction functions between the macroeconomy, the monetary and fiscal authorities, and the capital markets, examined through the lenses of cycles, liquidity, and market structures. In this episode, given the severe sell-off in the bond market, I thought it would be helpful to discuss interest rates and the US Treasury market. What we're experiencing now is the fastest hiking cycle in the past 4 decades, and bonds have never had 3 consecutive negative years. Now, Jim, do you think treasuries at these levels offer attractive buying opportunities? And if so, what do you think constitutes good value in treasuries? Jim?
Yeah, sure. So I think the answer to your question is yes. I think the sell-off in the treasury and the rates market represent a good buying opportunity. And there's numerous ways of determining what is the fair value of the interest rate, long-term interest rate. One way of doing that, I think people were talking about what is the R star, which is the interest rate is not restrictive to the economy nor stimulative to the economy. And the consensus right now is about 1% real interest rate. And if you think about the long-term inflation is about 2%, let's say 2 to 3%. So we're talking about 3 to 4% of the long-term interest rate, right? You can think about as a nominal GDP as well. So some people say, the interest rate should be close to the long-term nominal GDP. If the long-term real GDP is about 2% and the inflation is about 2 to 3%, then that will argue for the interest rate of 4 to 5%. And in our framework, we do not think these are good ways of, these are all good theoretical kind of calculations, and but they also give you a static, long-term equilibrium, right? And it's not how useful for investment and a trading perspective. Why I say that? The first is, this estimate may or may not be true. We do not know, what's going to be the long-term R star. And if you recall, a long time ago, if in the 80s and 90s, no one will believe that the R star is going to be, zero, right? Real interest rate, right? And during the panic of financial crisis, or just a few like 5 or 10 years ago, and people think the R star should be zero kind of real interest rate, and maybe 1%, maybe 2%, who knows, right? In the long run. Similarly, the nominal GDP, how do you estimate that? Even you can get nominal GDP estimated right for the next 10 years, it can have a big gyrations, right? So I would say even you get an estimated right for, let's say the interest rate should be 4%, 5% for the next 10 years. I can see 10-year interest rate first go down to 1% and then go up to 7 and 10% with an average of 5%. So I think that's interesting, starting point. But I think the more interesting thing here to do is look at what's the direction from here and how far whether we can go from our current direction. So I think that's should be a more interesting discussion. Do you think? What do you think?
Sure. So, okay, so let's go straight to the specifics then, and talk about the details of the framework you use for determining which levels, especially given the current uncertainties or even confused state of the economy, are attractive. How exactly do you do it?
That's right. So what we're doing here is we follow the interest rate cycle. So if you look at it here, I have one chart here. The red line is the Fed fund rate, and the blue line is our market cycle indicator. Basically, Fed will hike interest rate during the economic expansion when the inflation becoming a concern. By hiking the interest rate and tightening monetary conditions, it will result in economic slowdown and eventually recession. And once the recession hit, Fed will turn around and cut the interest rate to deal with unemployment rate. And this cycle rings and repeat, all right? And at the current juncture, the Fed is, as you mentioned, that we just have the biggest, most drastic hiking cycle in the past 4 decades. We hike interest rate from 0% to 5% within less than 2 years. So this is the most drastic hiking cycle. And at this point of time, and based on our indications, that it has become sufficiently restrictive to the financial conditions to cause the slowdown of the economy, and eventually with a high probability of a recession. And so if we take that assumption that this is restrictive enough, then we think short-dated rates present a good opportunity. And then a lot of people will argue then the longer dated of the interest rate may not present a good value because curve is inverted, right? And if we look at history, curves typically are inverted or close to inversion when the short-dated interest rate at the peak of the cycle. In other words, before the recession hit, and curves are inverted, and that's the time is the peak of longer-dated interest rate as well. So longer-dated interest rate typically peak at the inversion point. And from that perspective, it also argues for the long-dated interest rate to come down as well. Obviously, during the recession, when the Fed resort back to the easing cycle, Fed will cut interest rate faster than the short-dated interest rate will fall faster than the longer-dated interest rate, and that's what we call the curve will steepen, bull steepening during that phase. So that's why I think based on the current interest rate cycle, we think the interest rate is close to the peak because they have been very restrictive and they will cause significant economic damage and eventually will force the Fed to pause and to revert. Now, this does not necessarily mean it cannot go higher for another 25 bips, 50 bips, and 1%, etc. I mean, it does not provide a framework for the short-term movement, but it does provide a framework in terms of where we are in the interest rate cycle.
Right. So now there's something let's turn to something that we hear a lot about in the media, which is the supply and demand imbalances when it comes to U.S. treasuries. Now, what exactly are these, and what's the magnitude of these imbalances?
Yeah, so I think the media have talked about a lot about this, and so it doesn't mean that we have differentiated views. We're just pointing out the obvious one. But I think we want to underscore that the supply and the demand imbalance is so big and it deserves a big attention from the investors. So if we think about on the supply side, right, our budget deficit is a little bit more than 8%. And mind you, this is during the record low, unemployment rate. Okay, and so if you take 27 trillion of U.S. GDP multiplied by 8%, that's more than 2 trillion of deficit, and that requires a new increase of net issues of debt, right? So that is very, very big number. Now, I think we in the past, the U.S. have run into budget deficit before, although at a smaller number, and we do have a lot of non-economic buyers for that. The first one we can think about is the emerging market reserve managers like China, and some other surplus nations like Japan, right? And they have been buying the U.S. Treasury, and at the same time, since the global financial crisis, Treasury, Fed has been doing QE, so they have been buying U.S. Treasury as well. And finally, after U.S. QE, Japan and the U.S. Are doing QE as well, and a lot of the money actually came to the U.S. And the reason for that is because the U.S. offer higher yield, and in Japan and the U.S. In Japan and Europe, the yield are significantly lower. So in the past, we basically have Fed is buying Treasury, emerging market, and the reserve managers were buying Treasury, and the Japanese investor and the European investors, because of the QE, all the money came to the U.S. as well. Now going forward, the picture cannot be more different. From the Fed perspective, we are, instead of QE, right, we are doing the QT. And if you look at the past kind of Fed balance sheet shrink, in the past, 10 to 12 months, I would say, a decrease of balance sheet of 70 billion a month, right? And China, instead of accumulating Treasury, and they are running down of their U.S. Treasury positions. And now this chart, I also the Japanese investors and the European investors, and they are not buying U.S. Treasury, despite of the fact U.S. Treasury offers a higher yield. Now, I'm not saying that there is no other, no one is, no Japanese and the European investors buying. I'm seeing a lot of, the conservative investors who are doing the currency hedgings. They do not see the higher yield here. And this is because of the inverted yield curve. So I have a chart here showing that the excess yield in the U.S. Treasury after currency hedge, and you compare that with domestic GGBs, and as you can see, actually is actually negative. So the red line is the hedged U.S. Treasury 5-year after currency hedge, okay? And you take that, the difference between this one versus the 5-year GGB, as you can see, is negative 1.5%. So the after currency hedge Japanese U.S. Treasury does not offer the higher yield. The similar thing is, happens for the European investors. So the chart here is a little bit, is different in the opposite direction. So there's the bond yield, 5-year bond yield less than the hedged 5-year Treasury. You can see after the after the global financial crisis, and once the European engaged the QE, it's better for most time period. It's better to invest in the United States Treasury and hedge for the currency risk. Okay, and that's not the case in the past 10 months, I would say 12 months. And for the European investors, actually right now, it just come close to zero. So they are indifferent, okay, between the US, Treasury yield versus their after currency hedge versus their bond yield. So, so I would say the natural buyers are not there, and this will cause a significant problem for the liquidity conditions. Should we talk about, what the impact would be?
Well, I was just making the point here that you just made a very strong case, at least I thought so, for me and the casual observer, that these imbalances indeed would, in a normal world, lead to higher yields in the longer run. Now, or do you think there is another conclusion one can reach, Jim? Yes? No?
Yeah. So I think this can be confusing, right? The law of supply and demand will say if you have so much supply and you have a limited demand, then that should result the price lower. And in the treasury case, the yield higher. So lower price and a higher yield. I would say that conclusion is too simple to draw, right? And the reason for that is because what we are looking here is basically a liquidity drain on the entire financial asset across all the financial assets, being the interest rate, a bond, equities, credit, private investment, and etc. So this pressure will be distributed across all the financial assets. Now, how they're going to distribute it, it will really depend how these financial assets are priced versus the future growth and the inflation expectation. And also based on the relative valuation among themselves. So I can give one example. If you look back when the Fed started engage QE, and basically you have uneconomic buyers, right? So in that case, the supply you have increased demand, right, from the Fed, and that will argue for the higher price of Treasury and the lower yield. But if you notice, every time of the Fed started QE, and Treasury yield actually went higher, okay, and the stock price went higher. And the reason for that is because the growth pick up, earnings pick up, and the money leave leave the treasury and the credit and goes to chase higher higher growth asset such as equities and private equities and etc. Now, right now, you can also argue the reverse can be true because because of the relative valuation among themselves, right, versus the forward-looking growth expectation that can result, actually the opposite effect. See, for example, the bond market is priced for soft landing scenario, and the equity market is priced for the growth reacceleration. And if that's not the case, then the money may come out of equity to fund the bond. And the relative valuation between themselves also will determine where the pressure of this liquidity will be most severe. So that's what I think. Actually, in the end, you may end up with the bond prices higher, yield lower, and with significantly lower overall levels of the financial asset.
Okay. Right. I get it. So, okay. So liquidity pressures, how they play out depends on relative valuations between assets and the relative valuation of these assets to forward growth and inflation expectations. Fine. But let's get down to some practicalities, because I think that's what we all care about, partly at least. So applying this framework, how do you reckon equities and bonds currently price in expected future growth and inflation?
Yes. So we'll talk about that. I just forgot to mention that the interest rate is, so people confuse between interest rate and the treasury yield, right? In the end, they are two different things, right? So the interest rate is basically, if you think about the interest rate, is basically the integration of the forward-looking policy rate. So what the policy rate will be 1 year from now, 2 years from now, 3 years from now, 5 years from now, right? That will give you the forward interest rate, right? What I meant here is that interest rate is primarily determined by the growth and inflation expectation, because that in turn will determine the policy rate, correct? Now, the treasury supply and demand will result in the treasury yield deviate from that interest rate. And that deviation, you can measure it, for example, using the swap spread. So what I meant here is the growth and inflation expectation will be the primary driver for the interest rate. Now, the supply and the demand of the treasury will impact the swap spread, meaning the treasury yield against the swap rate. So coming back to your question, does that make sense to you? And then we can come back to talk about
Sure.
the implied pricing, for the bond and equity.
Okay. Yeah, that makes sense. So go on. Yeah.
Okay. So now let's start with the Fed fund rate, right? With the interest rate. So for now, basically market is priced, 50% of probability Fed may hike, by the end of the year, right? And then after that, gradually it says, Fed will start to cut interest rate. And if you look at a graph here, the market is saying, sometime in the middle of next year, Fed will start cutting interest rate, and the policy rate may come from 5.5, and down to 4.25% something, and then level out from there. So that's kind of forward-looking, kind of the Fed fund rate. What does this tell us? This tells us, the rates market is back, kind of a softish landing, right? In J. Powell's word, it's basically, economy will weak, inflation will come down, but not a big deal. It's very minor, right? So that's basically what the interest rate, the market is pricing for that. If you look at the credit and the market, right, and they basically saying there is no problem in terms of the rising bankruptcy rate, although despite of the fact the bankruptcy rate has come up a lot, and the Fed and the banks have tightened the lending standard and etc. The corporate credit spread is very well behaved. So if you look at the U.S. kind of investment grade bond, it's about 125 bips of kind of the spread, and what's the upside? I mean, it can go down to 1%, and that's not much upside for the credit. What's the downside? I mean, if you look at during the great financial crisis, and it can go all the way up to 6%, right? So that's for the IGs. Now for the high yield market, the same thing. We are at about 430 bips, right? And that is lower than the long-term average, right? And how in the rosy situation, then how about how far you can go and how much better you can get? I mean, yeah, you can get a 100 bips of the rally that will give you the lowest point in the past 20 years. But downside is big. The credit spread can widen to 10%, 15%, 20%, depending on how severity the economic recession will be. All I'm saying here is the credit is priced, pretty rosy situation. Now let's talk about the equity. Although talk about equity, pricing, I think from the surveys you see the equity price has come down by, let's say from the peak towards the end of 2021 until right now, it's come down about 10%, right? Give or take. And if you look at the forward earning ratios, and it came adjust from 20 to 18%, right? Then if you look at the forward earnings, it was priced for the forward earnings to increase by 10 to 15% in next year. So in other words, although equity price has come down, but it's mainly driven by the repricing of the multiple. By the way, I think that repricing of multiple is not enough, given the given the level of high interest rate, but nonetheless is really driven by the compression of the multiple. But in terms of earnings, is actually priced for the acceleration from here. So what we're looking here is basically the equity market is priced for acceleration of the economy and the earnings growth. So I think in terms of against our the economic scenario, where we see here is that we see the growth is going to slow down. So we do not see we do not see the earnings acceleration here to be a likely scenario, and we see inflation to come down against that backdrop, and with a high probability of a recession. So against that backdrop, I think the bond is represent a better valuation.
Right. Okay. Well, okay, but let me push an argument here. So we have seen 5% interest rates before, and given how well the labor market still is working, or how strong the market is, and the economy, how resilient the economy is, that inflation is coming down, and consumer spending is still fairly strong. So why should 5% interest rates be bad for the economy? Yes, the economy, the strengths, the resilience of the economy has been much stronger than anyone expected, we think. And that's good in some ways. But why do you then think that a recession is around the corner if it hasn't happened yet?
Right. So there's multiple questions. I mean, the first question you're talking about is the level. You're basically saying that we have seen 5% interest rate before, and why we're worried about 5% interest rate. I would argue that the more important thing here is not a level of interest rate, but rather the change. So if let's say the Volcker cut the interest rate, during the Volcker time, Volcker hiked the interest rate to close to 20%, and once you lower to that to 8%, right? That is big stimulative. That's very stimulative, even though the interest rate was at a higher level, which is 8%, right? Now we are increasing the interest rate from 0% to 5%, and that is a tightening. So the magnitude is the direction is very important. And the second thing is the magnitude, right? And the speed. So we just talk about the magnitude, and the speed is the most drastic. Now, if you consider QE as a QE was a way to cut interest rate below zero, which is argued, if you look at Atlantic Fed, I think they did a research basically saying when we were at interest rate of zero, and if you're doing the QE, effectively, how much interest rate cut that you would have done when you conduct monetary policy under zero interest rate environment. From that perspective, you can argue that interest rate hike that we have is actually more than 5.5%, from zero to the upper bound of 5.5%. So the way the way that this will work into the economy, it takes time, right? And it take based on our work, and this is about the time that the monetary policy would start to have the impact into the economy. And I think it is very visible as we see here right now. Typically, when you hike the interest rate, it first will work into the most interest rate sensitive sectors, such as housing, and we see the housing market is basically frozen, and we have the lowest transaction volume, right? And then the next one is auto, and we see the auto market is basically have a severe decline, right? And then you will work into the other work into the other sectors. Now, the inflation and the labor, these are the two data points that a lot of people quote about the economic resilience, and typically are the two most lagging indicators.
Right, yes. they are lagging, and who says they will not be lagging forever, right? Because
Right.
there is this common narrative about structural reasons why inflation actually will remain sticky, and it will be very difficult for the Fed to force it down to a low and sustainable level. So, for example, we're right now going through these geopolitical changes that also affect the global economy, and we're reversing a lot of these developments that have been going on for the past 20, 25 years. So what I mean is that the Chinese supply chains, or the European and US supply chains to China, are being reshored away from China to other emerging markets. And this transition in itself is expensive and will require restructuring. So that doesn't come cheaply. It will also affect, to extents we can't really gauge right now, how labor in these markets will be affected. Will it actually be as cheap and safe as we think it will be once we put our industry there? And we all know that some commodities, energy in particular, is not necessarily driven by economic rationale. It's energy, crude pricing is as much a political tool as an economical traded asset. And when it's used as a political tool, it tends to be used to the detriment of the US. So these are all structural arguments that the Fed can't do anything about. So do you still think, or do you really think the Fed will be able to push inflation down to whatever levels it has set its target on?
Yes, we do. And as a matter of fact, all the argument that you talk about that that you quoted, we wrote about them, and in the fourth quarter of 2020, where we expect inflation to pick up. And a lot of them are secular forces, such as the global supply chain reshoring and the delinkage from the Chinese supply chain, and the lack of investment in the commodity will probably result in the higher commodity prices, and all these things that you talk about, and we completely agree. And however, during the so we expect inflation to pick up, and at the same time, we saw the record fiscal stimulus. By the way, they are monetized by the central bank, and that's basically almost a destiny for higher inflation. And I would say during that time, basically that lays the seed for the inflation that we saw in the past few years. Now I think the opposite is true, where the Fed has tightened the monetary policy enough, and that will result in the falling demand, and eventually will result in recession, and inflation will inevitably fall. And that's a cyclical force. And in the context of potentially highly inflationary environment in the secular kind of an environment. And I would say, during the pandemic time, or soon after that, the government, pushed out a lot of money to the consumers, and they cannot consume the services because they are stuck at home. So they buy a lot of goods and services, and the supply chain certainly exacerbate the problem and cause a high inflation. And then gradually that rotate into the service after it is opened up and people start to travel, and you see the service factor inflation start to pick up, while the goods inflation has already been falling for quite some time. And now I see all these factors, the goods inflations and the service inflation, and they're on the way down. Although I can see the headline CPI to come back up a little bit, because one is the base effect, right? And secondly is that we do see that the commodity price has come up, a little bit. But I think the key thing here is that housing is a big component of the CPI, and certainly the big, certainly is the most, kind of sticky component. And I can see, it's a very evident housing sector is materially slowing down and the rent is coming down. Unfortunately, it's adjusted very slowly. Okay, so the core I can visualize the core inflation come down and the headline CPI may rebound a little bit, and overall the inflation projection is to come down.
Okay. So
now, just to add to that, that does not mean that in the long run that I do not see the inflation come back up again, as you mentioned. I can see inflation to come down in the next 1 year and 2 years during the recession time period, and then I can see fiscal stimulus to come in, and eventually it will force the Fed to monetize the debt, simply because the market cannot absorb those absorb the increase of the treasury, and that will lay the foundation for another leg higher of inflation. So in this sense, I think the sequence also matters more than the level. In other words, we expect inflation to come down and during the economic downturn, and then once the stimulus come in, and that's the time you need to worry about inflation.
Okay. Now, let's actually talk about the inflation target that the Fed has. Now, Chair Powell often restates that the Fed's aim is to bring down inflation to 2%. And this target of 2% has been official policy since Chair Bernanke introduced it in, I think, early 2012. Now, whether 2% is a reasonable target or was a reasonable target then, that's a different topic and an interesting one, especially if one tries to trace where this number comes from. Now, my question, though, is not whether 2% was a good target back in 2012. My question is more, given all the changes that we've seen since 2012, geopolitical changes, not only actual, but also the perceptions of geopolitical changes leading to all these economic changes and the reshoring and the changes in supply and demand for US treasuries. Does it really make sense for the Fed to stick to the same 2% target now as it did back then? Or should the target be something else?
Yeah, so I think from our perspective, I think the question is we don't know, because we try not to make a judgment on, whether it's the right thing or wrong thing to do. We just want to try to figure out what is the likely thing they're going to do and what's the consequence of the market. I mean, 2% is an arbitrary number to start with anyway, right? There's no official kind of a documentation says 2% is optimal. However, if your question is that, as a lot of people say, Fed will adjust the inflation target to 3%, and therefore they are done with it, and therefore everything will be fine because they will live with the inflation and with 3% target, and everyone is happy. And I would say this is not likely, and the reason because Fed conduct monetary policy a lot is based on their credibility and the forward expectations. Okay, if they adjust the inflation expectation to 3%, that's almost indicate that they're giving up of fighting of this inflation, and it can be counterproductive. Keeping 2% of the inflation target, and that will give them the credibility in terms of react to the inflation expectation, anchoring the longer term inflation expectations. So therefore, I do not see that they are going to change 2%, inflation target to 3%. Having said that, this is under the current condition. It doesn't mean they will not change that in the future. All right. So in the future, if we have in the next cycle, say for example, they can once they want to boost the inflation expectations or conduct the de facto yield curve control, where they can say the inflation target either explicitly or implicitly for 3%, but not at the current juncture.
Okay, good. So we follow what happens in the world and we adjust our actions accordingly. We don't tell them what to do. Makes sense. So now all of this discussion really has, leads to, I mean, you said it yourself, that bonds are more attractive than equities right now. Now, do you have any other actual details to show to support that view?
Yeah, definitely. So I think we're talking about two things, right? The first thing we're talking about relative to the growth and the inflation expectations, where we think that a bond is better priced based on our outlook of the growth and the inflation expectation. Now, let's say that we are wrong about this growth and inflation expectation. Let's say the market is the same as the past cycles, and without making any judgment of the forward-looking growth and inflation expectations, where are they priced relative to each other? And I think, we can take a very simple exercise. What you can do here is you can look at the 3 months TBL is 3.35%, right? And the 10-year, so we have an inverted yield curve, right? So it's about 4.75%, right? That's a 10-year. The investment grade bond will give you a pick of a yield of about 125 bips, right? So that will give you 6% of the yield, slightly higher than 6%, 6.6 and 6.25, right? Of the investment grade bond, right? And if you compare with that with the dividend, with the earnings yield, right? The earnings yield basically is the inverse of the PE ratio, right? The PE, and that will give you a yield about 5%, right? You take the difference, that's about -1%. And if you look at the history, and this is at the lowest point in the past, I would say more than 20 years, right? And we have a chart to showing that. And then actually historically, when this is moving, so we also construct a kind of a 2 standard deviation band of that. And historically, when you go out of that 2 standard deviation band at that magnitude, and typically the result adjustment of significant of the risk premium for the equity market. As you can see here, you can look at an example during the tech bubble and the example of subprime, and this is basically the 3rd time that we went below that 2 standard deviation band. Obviously, you can also using the other we can do another exercise, basically compare that bond investment grade bond yield, right, which is a 6.25, right, 6%, versus the dividends, which is about 2%, right, and 2.5%, something like that. The difference is about 4%, right? So if you look at the history, right, so we have a chart here, basically showing the equity risk premium measured using the dividend yield, and then we also construct 1 standard deviation from the 5-year mean, and as you can see, this is also in parallel to the versus the band that we have is in parallel to during the burst of a tech bubble and the burst of a high housing bubble, and is the lowest equity risk premium in the past 20 years, right? So from that relative valuation perspective, that the equity market is just does not offer you a lot of the risk premium, among them. Now, I think that the exercise, if you look at a very simple way of looking at that, I talked about this before. S&P have dropped 10% from the peak level, right? And now the PE ratio has adjusted from 20 to 18 times, right? So if you look at the history, let's say during the tech bubble burst, right? The PE ratio has come down. I'm talking about the forward PE, right? Come down to 16 times, and during the subprime, it comes down to 12, times, right? So let's say they didn't come down. They are not coming down to 15 times. They just come down to 15 times, right? So 15 times, from 18 times to 15 times, that's about 20% of the return, right? 20% of the drop just for the for the PE, multiple contraction. Now, the earnings, historically, the earnings coming down, during the recession is 20%, right? And the current forward earnings is priced for 10%. So the delta between them is 30%. 30% of the earnings readjustment, 20% of the compression of the multiple, right? That's a 50%. So now I'm not forecasting 50% of the drop. I'm just saying this is in the worst case scenario, right? We have a recession similar to the Great Depression, to the Great Recession and the burst of tech bubble, and we have a kind of an average adjustment of the earnings during the recession. I mean, you could go down 50%. Now let's talk about the upside, right? So the earnings, let's say economy reaccelerate from here, right? And I do not see the interest rate can go lower, right? If the economy reaccelerate, how would the interest rate come down? So in that sense, I see limited kind of a multiple expansion. So, the market is already priced, 10%, 15% of the earnings growth. Now you really need the earnings to grow 20%, right? In order to deliver a good return, right? At least to beat 6% of the yield of the investment grade bond, right? So I would say if you look at the risk reward perspective, they're just not there, right? Similarly, I mentioned about the high yield, the corporate spread, which is basically you have a limited upside, right? So you can compress the credit spread a little bit, but not much. And the upside, the downside is significantly high. So that's basically is my key point in terms of the relative valuation between them. I do not make a judgment in terms of where they will go. And that will require two things: the assessment of the economy at this particular juncture, and also some of the indicators, as you widely know, that we follow. But rather just say, if we just come here and see what's the upside and downside, and then I think the picture is pretty clear to us.
Yes, indeed it is. And yes, it can become ugly. So, okay, so now we spoke a lot about methodology in our first episode, in our first installment, and we talked about the details of how you think today also. So, so you have this consistent framework that we've been talking about, as with every model or every framework, there are certain assumptions that underpin the methodology. For example, in your case, the reaction functions of central banks and so on. So my question to you is, are there any particular components of your framework, the way you think about the economy and the markets, that worry you in the sense that what is it that could change suddenly, unexpectedly, that would be a challenge for you in understanding the financial system?
Yeah, sure. So, everything we talk about is basically, I think what we're trying to do here is we try to understand where we are in terms of the implied pricing for the market, and we compare versus what's the scenario that is likely to transpire. Well, it doesn't mean that they will transpire as we are expecting, right? So that's the uncertain component. So we're talking about the interest rate market is priced for a soft landing, meaning there will be a landing, but it's very soft. The equity market basically saying the soft landing is over, okay? And the economy is going to be reaccelerating from here. So that's the embedded pricing from there. The large movement deviate from this is going to be different economic scenario that is playing out against what is being priced. In our scenario, in our expectation, we think the growth is going to slow down, inflation is going to slow down, and with a high probability of the recession. As a matter of fact, the recent reprice of the interest rate give us higher confidence that our base case scenario that it may have higher probability to materialize. Now, we could be wrong if, let's say, the Fed, let's say the government engage another round of a fiscal stimulus, right? And in that case, that earnings may reaccelerate for the shorter period of time. Obviously, that may also create inflation expectation, and the Fed may resort to tighten the monetary condition further. So in that case, it's uncertain whether stock can go, how high the stock can go, because on one hand, the earnings may go higher than what is currently already elevated level, and at the same time, the multiple may contract if the Fed have a credible reaction function. In other words, they will tighten further, right? And in that case, the bond have more downside, and the upside of the equity market, I would say, is questionable. Then another scenario is basically the Fed preemptively cut the interest rate, all right, in the absence of the turmoil in the financial market, or in the absence of the uptick of unemployment rate. I would say this is not likely, judging from the history. And typically, the Fed will need some extent, either from the financial market or from the real economy, for them to really take the easing method approach. And if you recall, in the some people compare. I think the best case scenario that you can compare with is 1990s, where the Fed hiked the interest rate, right, and that resulted in the bond massacre, right, in 1994. And then after that, you have a series of crises. You have Asian financial crisis, you have Latin American financial crisis, and they all happened overseas. I mean, they were not impacting the United States. And in any case, the Fed basically paused at the lower interest rate. And then you have a long-term capital hit, right? And the Fed, lowered the interest rate, right? And then ultimately that result in the tech bubble, right? And then the Fed hiked interest rate, and then we know what is the history. So this can really be prolonged, and that's not our base case. But if there's an accident and the Fed just pause and cut the interest rate, and if that accident does not impact general financial market, and the Fed is able to ease the financial condition fast enough and big enough, and then I think that could engineer a situation that all the financial assets really take off from there. But I would say, because of the sticky inflation that you were mentioning before, and that make this one less likely. In other words, in all those time past period, and you can also argue, like, since the great financial crisis, the Fed was able to react. So we talk about there will be like 1 or 2 year mini cycle, right? Every time there is a weakness, Fed will come in and able to do another round of QE, right? And in 2018, when there is a significant decline of the equity market, the Fed is just coming and they say we are done and we're going to cut the interest rate. So that is not going to be the case anymore because of the high inflation. Therefore, because of that, we think that a decisive downturn is a more likely outcome. And obviously, the uncertainty of a Fed change of Fed reaction function certainly can change our outlook.
Okay, interesting. So we're coming toward the end of this podcast. So I think it's time to try and get out of the weeds and get some higher level understanding or draw some conclusions and takeaways. So it seems to me that the primary lesson of this discussion is that the environment or system within which interest rates are determined is dynamic and highly nonlinear. So, for example, a relatively static observation about imbalances in the demand for and supply of treasuries is only one component of several interacting forces that form a constantly changing market price. The complex dynamics, in other words, may be, well, what matters the most for the markets, not some theoretical, long-term static equilibrium that we may or may not reach, right? So it's the path that matters. And the second conclusion that follows from this really is that as geopolitical realities and perceptions of the realities change, invariably, the dynamics of price formation will be affected. Policy making will be changed, for example. And it is very hard to tell how this will impact price levels. But of course, the more uncertainty there is and the greater the risks are going forward, the one outcome that I think we can deduce will be upon us is that there's a good chance that volatility will increase going forward. At least that's how it feels to me. Jim?
Yeah, sure. I think that's a very good summary, Henry. And we have spent a lot of time, and maybe it's time to say goodbye. And do you want to tell the listeners where they can follow us?
Of course, wouldn't want to lose them. So you can follow us if you search for Total Convexity in your favorite podcast apps, or on YouTube. We're there too. And don't forget to click on the subscription button so that you will be notified when we release the next episode. You can also follow us on X, that is old Twitter, where we have the handle @TotalConvexity. And you can email us at totalconvexity@gmail.com. You can also find us at Substack, totalconvexity.substack.com. And we promise to be good guys. We will never spam you or haunt you with advertising or marketing. We will just talk about the markets and try to have some fun. Anything else, Jim?
Not really. So thank you, everyone. If you like this free podcast, we would appreciate if you can pass along to anyone who would be interested. This concludes the second episode of our podcast, Total Convexity. See you next time.
Disclaimer. The information provided in this podcast is for general informational purposes only and should not be considered as financial advice. Consult with a qualified financial professional before making any financial decisions. All investments involve risks. There are no guarantees of profits, and investments may incur losses. The contents discussed in this podcast is not a recommendation for any specific investment. Past performance does not predict future results. The opinions expressed by guests on this podcast are their own and may not necessarily reflect the views of the hosts or affiliated parties. The podcast host and guests may have financial interests in companies or products discussed, and listeners should be aware that the opinions expressed by guests and their hosts may reflect biases. We strive for accuracy, but financial information can change rapidly. The content may not always be up to date or complete, so verify information independently. This podcast does not offer legal or regulatory advice, and listeners are responsible for ensuring that their financial decisions comply with applicable laws and regulations. Mentions of specific financial products or services do not constitute endorsements. Perform your due diligence before engaging with any financial offering. Listeners are fully responsible for their financial decisions, and the podcast's guests, hosts, and affiliated entities are not liable for any financial losses resulting from actions taken based on the provided contents.